Friends and enemies, welcome back to the episode of the Canadian Bitcoiners podcast, the CBP, here on the CBP Media Network. My name is Joey, and tonight I'm going to be joined by CJ Constantino. So you guys know he's been on the show before. He's a very, very bright Bitcoiner with lots to say about lots of different things, market stuff, Bitcoin stuff, trends, and more. And so we're going to get into all that stuff and talk about what he sees, what's going on, where are the risks, where are the rewards. Let's find out. Before we start, though, as always, two sponsors. Easy DNS, best place for you guys to host a website. We host our website there. I say this every week. I know there's like not much on it. That's more my fault and Len's fault than Mark's fault. Mark has been outstanding. If you want to do virtual private server stuff, so whether that's Bitcoin node, Nostr Relay, BTC Pay server, Mark just bought nodeless.io. I think I don't have it in front of me right now, but if you want to run a nodeless setup, because all that code is open source, obviously, Mark will help you set it up. Head over there. You can take care of that on your own. It's really a quality opportunity for you if you want to take care of that and spend some time becoming ungovernable, as it were. As well, PGP and GPG email, all your hosting needs taken care of by Mark. You can't really beat what he's got going on over there. So yeah, give him a look. EasyDNS.com. Use our code CBP Media, or just talk to him in the chat. He's here most of the times we do the show, or talk to him on Twitter. Find out what he can do for you. He'll help you the same way he helped us, for sure. Great guy, great friend of the show, and he's been a great partner as well. And of course, Bull Bitcoin, the second sponsor. If you want to buy Bitcoin in Canada, you have a couple options. There's ATMs, yeah. There's ShakePay, sure. But if you want to go KYC free in Canada, you only really have one option, and it's Bull Bitcoin. You go to the post office with your QR code from your account, you pay cash, and some government employee will take the cash and give you Bitcoin. At least they'll send the Bitcoin to your, or send the cash to your Bull Bitcoin account. Then you can buy the Bitcoin. Of course, it's not custodial, so they don't buy the Bitcoin and keep it. They buy the Bitcoin only once you've given them an address to send it to, which is outstanding. We like them a lot. Head over to their website, sign up. I think we have a URL. It's iwantbitcoin.ca. Without sharing too much data here, you guys have been spending a boatload on Bitcoin, which is great. You love to see that, even as things are tightening up allegedly in the economy. Even as the price is rising, the plebs are stacking, which is great. So head over if you want to pay your bills or you pay your property tax, all kinds of stuff at bullbitcoin.com. A full service platform for all your Bitcoin needs. With that out of the way, let's bring on our guest. CJ's here. Sir, it's good to see you again. Thank you for coming back to the program. How have you been?
Thanks for having me back. It's great to be here. I got to say, I'm really impressed with your background this time around, man. It's looking good.
I appreciate it, man. My wife and I moved from our first home to this home, I guess the end of September, beginning of September, I should say. And so I told people who listen to and watch the show and, friends of mine that once I moved, I was going to spend some money and put a studio together. And to be honest, I got to say, except for the Madex thing up there, it wasn't that expensive to put together. Everything is like from Amazon or sales at Wayfair or whatever. It was good. And I've enjoyed doing the show in here. So thank you for noticing. Now, your background is still today. I've seen you with backgrounds that are like wild, man. So I don't know why you picked that one. Maybe toning it down for tonight. I don't know, but it's fine either way.
The thing is I'm more concerned for you because soon that studio is going to turn into a playroom. So that's what happened to me. I got kicked out of my office. My office is the playroom, so I got to use pictures.
Don't get me started, man. Don't get me started. If and when I'm lucky enough to have a couple little ones, I'll happily give it up. Only on the second one though, CJ. The first one cannot have this. It has to be the second one. Okay, I got another room for the kids. So let's talk about this. I got some notes here. You've been tweeting an awful lot of stuff, buddy, about an awful lot of things. And on this program, I think we're at the point now where we only think about Cheech and Chong movie titles when someone says higher for longer, but there's not too many people outside of Bitcoin in that camp. I know that you have some thoughts on where the rates can go, can't go. We've obviously seen over here in Canada, another hawkish pause today from our bank talking about keeping rates at 5%. So our fixed rate is at 5 right now. I think you guys are a little more than that over there in the US, but talk to me a bit about where rates are now. How did we get here in your view? And is there any credibility left for Jerome and the boys over there? Like, they're talking higher for longer, but I don't see it. I don't think you see it. I want to know where you stand.
Yeah. So, man, diving right into the meat and potatoes. I love it. The thing is that I do think they're going to have a hard time getting the stay higher for longer. And that goes into the $34 trillion of debt, the $200 and now $12 trillion of unfunded liabilities, and just the absolute ridiculous budget deficit that the United States is running. So the interest rates go higher and they stay higher for longer. Well, the cost to finance that debt goes higher. All that stuff gets switched around, and it's going to cause more inflation, not less. That's kind of like the opposite of what you would expect with the higher rates, because it's the opposite of what they're saying. So I think they were definitely not expecting higher for longer for this long. I think they were expecting more of a really strong crash, either in asset prices or in the headline CPI.
Mm-hmm.
They're just not getting it. So they have to be higher for longer, because ultimately they're selling a narrative. Because if rates went lower, it would actually be less inflationary, believe it or not. So from like the demand side of people, yeah, people are going to borrow more, money's going to be looser, and yeah, you're going to have some positive price pressure from the supply demand equilibrium. But the inflationary pressure that's coming from the government having to print more money to issue the debt and to roll the debt is actually going to decline. So it's a balance, and there's a lot of variables moving back and forth. Either way, we're getting inflation.
Mm-hmm.
The way I say it is like this: if I'm right, well, then it's going to be a tough time for everybody, because rates are heading to 7.5 to 9.5% on the 10-year. So that's just gonna crush everything, including the government and the amount of money they'd have to print to finance. But if I'm wrong, and the rates go down because of, for whatever reason, they're still targeting inflation, right? What this really comes down to is the central bank is targeting inflation. They're targeting 2% inflation, and they're gonna reach that goal. They're gonna maintain that goal. And we have to prepare ourselves and protect our time and energy, not let it be diluted through their targeted inflation, and get it into Bitcoin where it can be properly stored and protected.
I want to hear if you have some thoughts, CJ. I'd be curious, because you do talk a lot about sort of where we are in the current state of affairs in the US economy. Why do you think they haven't gotten the crash in CPI they've been looking for? Because I know they talked a lot sort of at the beginning of the transitory, quote unquote, transitory narrative about we need inflation to come down to 2%. And I think it became pretty clear pretty quickly to a lot of observers, even some of the normies, honestly, CJ, if I had to guess, I would say that they quickly had to pivot to the direction needs to be correct. We need to be headed to 2%. We need to see clear signs we're headed to 2%. They haven't really gotten either, in my view. And I'll just point out once again to people who don't know that in the last CPI print, which came in, I think, 0.1% under expert expectations. Hilarious that we care about expert expectations after all these years. But, that aside, there was an adjustment on healthcare premiums that I think turned around that ship to the tune of negative 34% for the month. And so that number is not even really accurate to begin with. But worse, even with the cooking of the books, they're still unable to sell the narrative, as you mentioned there. What are the tools they have available? What have they done wrong? If you have a view on that, I'd be curious to hear what it is.
Yeah, I love this topic, because if you go back and you just look at where this all started, it actually started in 1996 with what was called the Boskin Commission. And back then, what they were looking to do was to make the numbers look prettier, and to reduce the deficit, because back then modern monetary theory was not as popular. So people didn't believe that you could just print money to infinity without there being some type of consequence. So they wanted to lower the deficit. It was a good political move. And actually, in that commission report, you read that they projected CPI was off by 1.1%.
Oh,
Because CPI was off by 1.1%, we should rethink how we do everything. So, I mean, it's ridiculous. And that change is really the catalyst to what's leading to the multiple percentage point inaccuracy that we see today. But to keep it short and simple and sweet, we used to use what was called a cost of goods index. And the cost of goods index was used to measure the cost to maintaining a standard of living. So, if you're eating filet mignon and the price of filet mignon goes up, then that affects the cost to maintain that standard of living of eating filet. But after the commission, what you find is that they actually switched their analysis to use what's called a cost of living index. So we went from cost of goods index to cost of living index. And the cost of living index is based on the cost of maintaining a given standard of living. So not the standard of living with a fixed basket, a given standard of living. So the way it works is it's substitution, it's hedonic. So if the price of filet goes up, but the price of hamburger meat goes down, they have the ability to ignore the price increase in filet and to apply the price decrease of the hamburger, because meat, beef is beef, right? And then chicken is chicken. So, if ground chicken is cheaper, but chicken breast is higher, they'll go with the ground chicken. And the same thing with all types of meats and all types of categories that we're in. So they literally get to look at the categories, the subcategories of the major categories, and pick what they want to substitute. And the justification for that is, well, when prices go down, people change their spending habits. Yeah, but the point of CPI is to measure the cost of a standard of living, not a given standard of living, because the given part there allows them to change and redefine that standard. So even with all of these manipulations that took place from going from the cost of goods index to the cost of living index, they're still not able to get the numbers down to where they need to be. And I'm not sure if you saw or not, but I'm actually working on this website called Govflation, where, because Trueflation was already taken. What a waste. What an absolute waste of a great name. It's like you go on there and it's like the number is lower than the government number. It's like, are you shitting me? What? The numbers like that. Trueflation, I think Trueflation was financed by the same people who are pulling the strings. And that's what the number would be if there were, some type of barrier. To get a lower number is just absolutely ridiculous and dishonest. But if you use the cost of goods index, and that's what my website's going to do, because, a lot of times people will reach out and, point fingers and say, you're a conspiracy theorist. Oh my gosh. Yeah. It's not anywhere near where it needs to be done. But what you're going to see on this website is you're going to see the real rate of return. And this is embarrassing. I shouldn't name drop this. This is all under development, so don't judge me on this. But this is important data, right? So you know what? Here's what I want you to do. Just in the URL on the homepage, govflation.com/stage-home. And just to give people a better view, now that you got these skills, you can pull this up real quick like this. There you go. Okay, so this is what people are going to see. You're going to see these are the most important things that you need to see as a money manager. Like if you're trying to protect your wealth, this is what you need to calculate. And to be honest, I'm sick and tired of manually doing this. So I'm in the process of automating this. And this is going to be a free website because this is critical information. Those charts that you see on there right now, they're just placeholders. We have custom interactive charts being built as we speak. But where we start is with CPI. So these numbers are actually government sourced. So that's really important because a lot of people will point to me and say, you're a conspiracy theorist. The data is not manipulated. And, it's true. The raw data is not manipulated. And thank God, the Bureau of Labor Statistics lets you get API access to this data. So the raw data is not manipulated. That's not what we're saying. It's the equations that they're plugging the raw data into that are causing the manipulations. So let's be clear about that. The data is accurate. The equations they're plugging the data into is what's causing all of the distortion between the reality of what's true and what they say is true. And right here, like for instance, US CPI right now, according to the government, is 3.2%. But if you go back to the cost of goods index, which is the original government equation, that's why we say right there, government sourced data and analytics. Trueflation is its own proprietary interpretation of CPI. Govflation has nothing to do with our own interpretation. It's simply going back to the government's original interpretation and sourcing their raw data and plugging it into their more accurate equations for proper analytics and analysis. So CPI today in the United States is actually 11%, over 11%. And that's not my opinion. That's just based on their original equation without the manipulations, without the switch to the cost of living index, which allows them to make substitutions. And the reason that that number is so important is because when you look at the real rate, well, the real interest rate or the real rate of return, you calculate that by subtracting CPI, by subtracting the rate of inflation from the highest US Treasury APY, right? So right now, because the yield curve is still inverted, the 3-month is the highest in the target range of 5.25 to 5.5%. So if you just say that it's 5.5%, you subtract it, the real rate of return is negative 5.57%. Now, that's really important because it's the real rate of return that incentivizes the marketplace, right? So in other words, when real interest rates are positive, the marketplace is incentivizing you to save because you're going to be able to buy more tomorrow. And when the real rate is negative, the marketplace is incentivizing you to spend or invest because you're going to be able to buy less shares, smaller home, worse car tomorrow. So the real rate is the rate that really creates the true marketplace incentives for the participants. And that's a lot of why you see all of this huge money flowing into the market. Like, why, yes, there was a lot of money that flowed into treasuries, over $6 trillion worth sitting on the sidelines right now. By the way, isn't, the definition of a liquidity crisis is a lack of liquidity, right? Everybody's in assets and they want liquidity. They want dollars. So the assets sell off so that they can raise the dollars. But a lot of people right now calling for a liquidity crisis, it doesn't really make a lot of sense because there's $6 trillion of liquidity on the sidelines waiting to buy the dips. That's not how you set up for a liquidity crisis. It's setting up for the opposite of that. Those $6 trillion are going to realize, especially if rates are forced to go down, right? If they can't go higher for longer, and if the free market says, well, we believe they're still going to get the 2% inflation, or we believe they're going to be forced to lower rates. If they still believe that, then the rates can be forced lowered, and then that's going to make the rate even more negative, and people are going to rush out of those $6 trillion, and it's not going to be a liquidity crisis. It's going to be an asset crisis, and Bitcoin is going to be the fastest horse in that race. And you're going to see prices just explode forward, and it won't even necessarily be inflationary because those prices are exploding forward, not necessarily because of the dilution of the dollar through the creation of more currency units, but because of the supply demand price pressures and dynamics. A whole bunch of people coming out of dollars and demanding assets to the tune of $6 trillion. So it's going to be significant no matter which way it goes. But I think another important thing to say here is rates would need to go up another 5.5 percentage points here in the United States just to be neutral, right? So you hear them talking about the neutral rate all the time. We're nowhere near neutral, and we're trending a little bit better because I give them the benefit of the doubt, and I or at least I try to. But the other thing is money supply. So you move to the next. These are all the most important things. Money supply, which they don't even keep track of anymore. They didn't even keep track of M3 money supply. They stopped keeping track of it because it doesn't support their narrative. And this is baselined. You'll see there in July, August, October. This is actually baselined. So the zero line is right before COVID. Okay. So once we entered into helicopter money area, we baselined it to that. So I think that's a pretty important. You hear today, there's 31.98% more money in circulation, and it was higher than that. So yeah, it's come down a little bit, but that's not going to be enough, right? You can't accomplish the goals that they're declaring to accomplish by still having basically 32% more liquidity. And a lot of people don't like, or at least the people I bounce this off of, they're like, why is that red if it's positive? Well, because when it's red, it's bad for you, right? When it's red is bad for you. Green is good. So you can see most of what's going on right now is really bad. And if you go to GDP, it's the same thing with real rate. It's very interesting how the GDP deflator works because it's not necessarily subtracting CPI. if you get into the technicals, it actually doesn't count imports. So it works a little bit differently. But the GDP deflator, for just to keep it simple, is basically the CPI. So when you have GDP, you have nominal GDP, and you're trying to figure out what real GDP is, meaning that when you take away for price increases, you can measure economic activity. Well, we got plus 0.5% this last quarter, which was absolutely amazing. We were one quarter away from being in a depression, because when COVID kicked in, GDP was actually negative 10.15, which a lot of people know the definition of a recession is consecutive quarters of negative GDP. But the definition of a depression is 1 year where you have greater than negative 10% GDP, or 12 consecutive quarters or 3 years of negative GDP. Well, 2020 lockdowns put us in an artificial depression where we went negative 10 in just not even just 1 year and 1 quarter. And then we've been building our way back ever since then, but we've been recovering. We haven't been growing. So when you look at what's really going on with real GDP, the economy has been slowly recovering, but there's been no real growth at all. We've barely recovered. And this was actually the 11th quarter. So if this was negative and then this quarter was negative, we would have met both definitions of a depression. We would have had 1 year of negative 10 plus 12 consecutive quarters of negative readouts. But this last quarter, we did get barely positive, but the economy is not in good shape. And I think everybody feels that. And that's why they're confident in the rates going down. But at the same time, when you look at what the real rate is, you have to understand that the rate can't go down, right? If the rate goes down, this real rate's going to go even more negative. And the more negative this rate goes, the more antsy that $6 trillion on the sideline is going to be hopping into the marketplace. So all of this is tied together to give you a snapshot of what I believe, in my opinion, what I use in my management system, the most important metrics to understand to get a basic picture of what's really going on in the U.S. economy, which drives macro overall.
That is a really, really great bit of information you gave us there. Let's pull on a couple of those threads. I'll do my best to remember the questions. So maybe we could let's start with the given standard of living thing. You mentioned that, there was a sort of closer to fixed, air quotes, fixed standard of living for a long time. And now with the hedonic adjustments, living has taken on a different meaning. It used to be a family with a picket fence and a dog and 2 kids, whatever. Now it's, I don't know, porn, Netflix, and Uber Eats, right? And the lifestyle has changed in terms of what they expect living to consist of in most places. And I personally, I have a big problem with that. I think that's one of the worst things that governments have done around the world, is change that standard of living. I want to tie that into this GDP number. Here in Canada, we have had a problem over the last 2 or 3 years, and it's really come to a head and become part of the conversation in the last year or so with per capita GDP. Our finance minister and our sitting government, and a lot of other, politicians, banks, whatnot, all agree that our GDP nominal, our nominal overall GDP number is going to keep growing at a rate that looks pretty good on paper. But it's lipstick on a pig in a lot of ways, CJ, because our population has gone up so much that GDP per capita number is dropping. And you see it, as I mentioned earlier, in the decreased quality of life, the standard of living that a lot of us are having. Do you guys have a similar consideration over there? This GDP number, is, plus, again, in air quotes, 0.5%. But if you did that per capita, how would that number look? Would you guys be in the negative as well? Do you have any idea?
Absolutely. And also when you account for government spending, we're deep in the negative. So a lot of GDP is actually from government spending. There's a big debate on this, whether that should be accounted for or not. I feel like it should be accounted for, because if you're not accounting for it, then you're really ignoring the issue, which is that they're spending money into circulation. Mm-hmm. So if they're spending money into circulation, a lot of people don't understand the different forms of the dollar: fiat cash, U.S. Treasuries, central bank reserves. All of these things are different forms of the dollar. And even if the government borrows the money, the principal balance doesn't transfer, right? So if they borrow $6 trillion, that $6 trillion still exists in that person's bank account, but then they're spending it into circulation.
Mm-hmm.
So I think government spending should be accounted for, but you're absolutely spot on. Per capita, this is not good. It's negative. And when you account for government spending, it's showing you that the government is actually being a crutch to the economy. The people are starting to depend on that government spending, and that's really dangerous. And some people out there might be like, well, why are they doing this? What incentive do they have? You know, or what motivates them to go from a cost of good index to a cost of living index? You know, well, that specific move was justified because they were able to, by stating the cost of living expense lower than it really is, the Social Security adjustments were minimized. So I think this past year, Social Security adjustments here in the United States are getting a 3% boost, but CPI is 11%. So
Yeah.
actually, imagine if Social Security, imagine if those payouts had to increase by 11% instead of 3%. So they're incentivized. The other thing is, they flip the natural world of economics upside down, because debt is supposed to be a liability to the borrower and an asset to the lender, right? If you come to me and borrow money, as the lender, I'm supposed to earn yield from you. You're the person who has to create the extra value and earn the interest and pay it back to me. So debt is an asset to the lender and a liability to the borrower, because you have to pay back in real terms. But I don't know why nobody talks about this, but if you think about it, it makes perfect sense. The two biggest borrowers in the world, right? So they talk about interest rates and like, oh, if interest rates go higher, people won't borrow. It's just a distraction, because the two biggest borrowers in the world are the government and banks. And the biggest lender is we, the people, right? When you deposit your money in a bank, the reason they pay you interest is because you're lending your money to them. And then they go and they buy an asset to back that liability, and they perform custodial arbitrage on you, because while they hold your money, while they custody your money, they're earning on the asset that backs your deposit liability. And then they don't share any of that profit with you. They pay you the interest that you agreed to when you lent them the money and made the deposit. So the banks are huge lenders, are huge borrowers, excuse me. We, the people, are the huge lenders. So the government is the next big lender. Obviously, just look at the debt clocks. That's all you need to understand how much money they're borrowing. And so they are actually having, if you really sit down and say, are they incentivized to do this, or are they just doing this to mess with us? No, they're actually incentivized to bring CPI down to the lowest possible output, because if they can sell you the debt with a real rate that's positive, like right now, if you take 5.5% and you subtract 3.2%, the real rate is positive. Mm-hmm. The government is going to sit here and tell you the real rate of return is over 2% in real terms. Well, that means that you want to buy their debt because you're getting a real rate of return, right? It goes back to the incentive process. As the lender, when the real rate of return is positive, you want to save, you want to lend, because you're earning interest, you're earning yield that's going to increase your purchasing power. But when the real rate is negative, you're not incentivized to lend. You're better off spending or investing, because even if you get that yield back, you're still losing purchasing power. And that government is incentivized, the banks are incentivized to create a lower CPI, because it's CPI that is subtracted from the rate, from the APY, to give you the real rate. And then it's this GDP deflator, which is basically CPI, being subtracted from GDP, which gives you the direction of the economy. So in both of those cases, they've flipped it upside down and rigged the system for themselves, because they themselves are the biggest borrowers. So they rigged the system to benefit the borrowers and not the savers. So it's kind of backwards from the way it really should be. And yes, they're incentivized to manipulate these numbers in order to convince you to lend them money. Because if you knew the real rate was negative, well, then you would know that it would make sense to lend money. You would be spending or investing your money, because those shares or that home or that asset is going to appreciate at a rate faster than the yield that you're earning. And I think a lot of people are learning that right now. $6 trillion lent to the US government, and they're getting all these yield for the last 2 years. and they can still buy less stuff.
Yeah.
So,
I think you're right. You're spot on all that. I'm curious if you know off the top of your head, when was the last time these guys squared up on the real rate?
oh, this has been going on for a long time. The real rate is so off. Like you won't even find this. The reason I'm building this website is because I'm sick and tired of running these numbers myself, and there's nowhere else to get it. If there was somewhere else to get it, I would just go there. I'd bookmark it and go there and make my life easier. This is creating more time and energy from me. This is taking more effort and cost to develop this, but this is a very important tool so that everybody can understand, not based on my opinion and not based on some wild opinion, just based on the government's original equations and their own data. You know, this is 99% of this data is API sourced from government sources like the Bureau of Labor Statistics, or the Bureau of Economics. So all of this is government source data, and all of it is their equations. It's just without all those manipulations to take away from Social Security, to convince people to lend them money, and to kind of flip the script upside down from what it really is. And people are waking up, and this is going to help people wake up a lot quicker because you see the real numbers right in front of you.
I know that you said that the raw data is not, bad data. It might not be in a lot of cases, but on this show, CJ, we've called the Bureau of Labor Statistics the Bureau of Downward Revisions a couple of times. And so I'm wondering do you have an opinion on like where that data, I shouldn't say where, and this is kind of a loaded question because I suspect I know the answer, but like, it's clear that they're maybe not being honest about the data on release day to look good for, the powers that be or whatever. And then next quarter they revise. Is that a concern for you? Are you not worried that other places are doing similar stuff and maybe not talking about it? I mean, for example, there's not revisions available in all these different government bodies, but it doesn't mean that the data on release day is honest. Does it matter, I guess, is the question I have, or are we just going to use the data and say, look, even if they are lying, the data still sucks and the outcome still sucks?
Yeah, that's a really good question. And my position on that is a lot of this data is not easy to collect. So I give them the benefit of the doubt because I understand the process of actually collecting the data. We're talking about 50 different states, hundreds of millions of people participating in the economy and getting this data. So I give them the benefit of the doubt. But when you see that they're making downward revisions 7 out of the last 9 months, it really does start to make you wonder what's really going on here. And I think those revisions can be explained as them cherry picking the data. Like, so in other words, okay, we're going to go with the hamburger meat. And then in the revision, they switch it to ground, instead of like ground beef, it's ground chuck. They'll do something. They're cherry picking that data. And then as the data becomes more accurate, if they incorrectly cherry picked, they'll switch which cherry they picked. Right? Because it's like, they just want to be able to manipulate the narrative because it really is about trust. I said it before and I'll say it again. The only difference between inflation and hyperinflation is trust. They have already printed enough money to hyperinflate the system. They've already printed enough money to hyperinflate the system. That's a hard pill to swallow. The only difference between inflation and hyperinflation is trust. And if they lose that trust, that's where my prediction for the higher yields come. At some point in time, they're going to lose trust in the marketplace. And I always like to point back to the March 2020 lockdown scenario and create a bridge to what I call financial COVID today. Because in hindsight's 2020, when you look back at what they were saying about death rates and how dangerous it was, all of that ended up being false, right? I mean, apparently in 2020, nobody got the flu. Not one person in the world got the flu because they all got the COVID. But that's because COVID's the flu. So when you look back, you're like, holy crap, like I can't believe the data was botched this much. Okay, fine. But what was the consequence of messing up that data? The consequence of messing up that data was people lost trust in the medical field. Here in the United States, people complained about the medical field because because of Obamacare and some of the other stuff that was going on with insurances. But it was never about like, well, I don't trust my doctor. It was just like, well, it's too expensive to go to my doctor. Now the cost doesn't matter. People are seeking new opinions. People are going to they're switching their doctors because they don't want the vax, or they won't eat. Some doctors, I had to switch my kid's doctor because they wouldn't let my kid come to the doctor without a vaccine. So I said, well, that's fine, buddy, because who do you think you are? God? I come here for your opinion. You don't tell me what to do. See you later, bud. And I went somewhere else because you're not going to tell me. I'm coming here for your advice. And it's a mutual respect and relationship to help me and my family stay healthy. I'm not completely dependent upon you. And I don't have to do what you say, like what you say is the rule of law. I lost trust in that. And a lot of my friends and family and the general public, they lost trust. And that is what's so important, because as the same thing is happening with financial data right now, people are losing trust. And if they lose trust in that narrative, that's when yields will shoot off, because inflation expectations will de-anchor. And the free market will have to discover, you're kind of letting me go here, but I got to drill into this.
Keep going.
A lot of people say the Federal Reserve has control of interest rates. And if you go and you look at the data, that's not true. A lot of the times the free market rates actually lead
Yes, sir.
the Federal Reserve.
CJ, I was just about to ask you about the 2-year leading the Fed funds rate. So I'm glad you brought that up. Keep going.
Yeah. So the Fed is more reactive. The smart money in the market is actually leading the way. So in other words, yes, the Federal Reserve may be forced to lower rates back down to zero in the future. But if the free market doesn't trust their narrative, the long term of the rates could go up. They don't have control over those rates. That's why they call it yield curve control. There's additional steps they have to take by providing liquidity, aka creating inflation, in order to cap rates and control rates. Just look at Japan. They don't have control. They're not able to state the 2-year rate or the 10-year rate or the 30-year rate. Not at all. They actually have to have an open market operation to tinker with those rates. And I wouldn't be that surprised. We were at such a critical point that, I mean, I had to make some pretty heavy statements in my threads, because we were getting to the point where if the yield curve uninverted at that 5.5%, then the process of uninversion historically has led to a 2 to 4% spread. So if the 3-month was at stated at 5.5, and the 10-year was at 5%, it was only 50 basis points from uninverting. Whenever that uninversion takes place, there's usually a huge sell-off. And that would have led to 7.5 to 9.5% rates, which imagine the interest on the national debt at 7.5 to 9.5%. I mean, right now people are concerned because it just broke $1 trillion and we're only at 5.5. So imagine that shooting up to 9.5. I mean, it would create so much inflation, so much price pressure because of the dilution of the dollar being paid back to people who then spend it into the economy. So you get it from the creation of the dollars, and then you get it from the supply demand side of people spending that yield. And the Fed, this is a real problem for them. They can state the rate lower, and the long end of the curve, the free market end of the curve, can continue to increase. But the only way that would happen is if people lose trust. So they have to abuse that trust. And that's what they're doing with this data. They're abusing trust. And it's got me a little bit like confused, because if trust is so critical, you'd want to be honest. You'd want to be able to secure people and let them know that you can trust them. Here's the data. It's not as pretty as we want it to be, but when it gets to where we want it to be, you know you can still trust us. They're doing the opposite. They're pulling a financial COVID. They're just simply lying about the data. You saw Biden the other day. Inflation is 0%.
I love that guy. It's unlimited content with that guy at the mic, man. I love it.
It's an embarrassment to our country. And you really think people are stupid enough to believe that inflation is 0%? If inflation is 3.2 and it stays 3.2, you can't say it's 0%. That's how you lose more trust. So all the actions that they're taking are really putting trust in the spotlight. And if they lose that trust, yields are going to explode so high that we will go into hyperinflation, because the amount of interest that will need to be paid for all of the borrowing and all of the rolling over and all of the unfunded liabilities and the continued growing budget deficit will require them to create large amounts of currency units and then to distribute those currency units into circulation so that other people can spend them. It's really bad. Now, if it goes the other way, though, like let's say people continue to trust them and the rates go down. Well, yeah, you'll get less monetary inflation because there'll be a smaller burden. The interest on debt would go down, probably back under $1 trillion. So that would help with the additional currency units that have to be created. But you have to remember the supply demand aspect of price discovery, right? There's two sides to every equation. You have the currency itself, and then you have the supply demand. So you have to take the supply demand of the currency first, and you have to say, okay, is this currency stable? Or is the supply dropping and the demand going up and it's gaining purchasing power? Or is the supply going up and the demand dropping and it's losing purchasing power? That's going to create a price pressure on that transaction. But you also have to go to the other side of the equation, which is the actual supply demand for the good or service itself. Is the supply going up or down? Is the demand going up or down? And both of those price pressures play a role in that market price that's settled upon to create that transaction. So if they lower rates, yeah, on the currency side of things, there'll be less monetary inflation. But on the supply demand side of things, where's that $6 trillion on the sidelines going to go when it can't get yield? It's going to go right back into the assets, and you're going to see demand outpace supply significantly. And then CPI is going to get pushed up tremendously. It's almost the same way. So it's like you lose trust and rates go to 10 and you get massive inflation, or you lower rates and people rush out of the dollar back into the marketplace and you get more inflation. There is nowhere to go. There is no deflation. It's inflation or inflation. And only Bitcoin can protect us from this.
I want to talk a bit about the trust thing. I'd be curious to hear your thoughts, CJ, about whose trust the Federal Reserve and the system at the end of the day needs in order to sustain. I think there's two, to really break it down to the simple terms here, there's really two classes of person who interact with the monetary system. There's the pros and the plebs, right? The pros are guys who are spending big money. They're running hedge funds. They're moving markets with their words, moving markets with their actions. And then there's guys like you and me, right? You might buy an ETF for your retirement fund. You might have a 401k match through work, whatever. You're investing through Robinhood or Wealthsimple here in Canada, and you're buying Bitcoin, whatever you're doing, right? Low dollar amount, just looking out for your family and yourself, kind of long-term, trying to protect your assets. I would say that there's a large part of me that thinks they've more or less lost the trust of almost all the institutional players already. And I say this because, as you mentioned, for the sort of free market elements of the yield curve are Fed disrespecters, okay, in a way. And you're seeing this play out. If they lose the trust of retail, does it really matter that much? I'd be curious. Like, is there something? Is there some nuance here that I'm missing? Because it seems to me like the important trust is already lost, and losing the trust of like Joey and CJ doesn't make that much of a difference in the grand scheme. If the big money and the guys who are managing money for the plebs as well, by the way, have already kind of started to stray. Do I have that right? What am I missing there?
Yeah, no, I'd say you're right. I think the regular people are the ones who are on the edge. But I'd say the institutions, that's where I disagree with you. I think the institutions still trust. I think the institutions are still trusting. And I think a lot of that actually plays into the fact of all the different financial products and services that have been built around the dollar as the reserve asset of this current fiat system. So there are a lot of products that allow you to hedge your cash flow, hedge your position. I mean, you have derivatives, you have options, there's just a plethora of products built around US dollars that not just domestically, but internationally, right? You have the euro dollar yield curve as well. So the institutions actually trust more than the people. I think a lot of the people who independently manage their wealth have already come to the conclusion that the real rate is negative. Therefore, I don't want your yield. I want to buy real things. And that's where a lot of this positive price pressure is coming from the supply demand side. And then the other piece of that positive price pressure is coming through the continued dilution of the dollar. But if the institutions lost trust, either because those products and services were no longer offered, or because it was evident that the Fed lost control of the yield curve, then we're going to have really big problems. And I think what's most exciting actually for Bitcoin, I've been working on People's Reserve now for 2 years. And it's been a grind, and we're getting really close to going live. And I'm sure you saw one of our tweets about our self-repaying mortgage product. So we have been building the same products and services that have built that institutional trust in the dollar. Even though the dollar is inflationary, they still have the proper tools and products and services to hedge, to manage, and to solve some of the problems that are created through the fact of that the government is inflating the dollar. And that allows them to kind of feel like they're outsmarting the system, right? With the real rate, you're still losing purchasing power, but they feel like they're able to hedge and be protected. And that builds trust because you feel like you're delta neutral when you're really not, because you're using the wrong numbers to plug into your equation. That's what's coming for Bitcoin. We're building products and services that are going to allow people like us who have already lost that trust to actually come into the Bitcoin ecosystem and take advantage of knowing what the macro condition is and benefiting even more so. A lot of reminds me of that hash price forwards that you see now in Bitcoin mining, right? So now you can actually say if difficulty is going to go up, if hash price is going to go up. So as a miner, you can hedge your hash price, right? We're a commodity producer. We're producing hash rate, and it goes back to the fundamentals of the traditional system, which is like if you're a farmer and you're growing corn, and you have the if I farm all of my corn, I'm going to make $200,000. But what happens if everybody farms all of their corn and nobody has any problems and the supply is a little bit more than I thought it was going to be? I might only make $120,000. But that's not okay, because if I don't make 140, I'm going to have to shut down my farm. So you can go into the market and you can use a derivative and you can hedge your production of your corn. And you can say, okay, I'm going to go short on corn. So if there's an oversupply of corn and the price goes down, your short position properly hedged your production. So yeah, you didn't make $200,000 because everything went the way you thought and you took a bigger risk, but you made 180, but you only needed to make 140. So instead of making 60, you made 40, but you protected your operation. That forward hash price is a very good example of the products and services that are coming down the line from real Bitcoiners and Bitcoin only companies who understand that Bitcoin is the reserve asset of the internet economy and the most pristine form of collateral in the world. And that's going to allow the people who are rightly so lost trust in the dollar to gain access to these institutional grade products and services in order to take advantage of their stack. A lot of that wealth is stuck in the internet economy. If you have a big stack of Bitcoin, you have to sell it. You have to pay. That creates a tax obligation. You got to bring it from one system to the other system. I mean, there are products coming down the line that are going to let you post Bitcoin as collateral and turn it into a real world asset without having to give up ownership of your Bitcoin. And yes, you'll create a monthly liability, but much better to create a 6% yearly negative cash flow liability than to sell everything up front, lose any upside potential, and then have a 20% obligation. I mean, you could borrow against your Bitcoin for 3.5 years before you lose that same amount of equity. And in the dollar system, they can already do all this stuff. So the institutions have an extra level and layer of trust because of all the products and services built around the dollar as the reserve asset of the fiat system. But Bitcoin is now going to be positioned to compete. And I think that is going to help some of these institutional players who are already starting to see the writing on the wall. They're already starting to see that even though I'm properly hedged, I'm still losing. So where can I go? Well, the answer is you can go to Bitcoin. And in the coming years, all of those products and services are going to be there to empower not just the institutions, but the regular plebs like us.
Yeah, man. I mean, we're coming up on time. You mentioned the self-repaying mortgage. I saw the tweet. Of course, CJ, I need to know more about it. People listening, watching want to know more about it. It's interesting because you are one of the many, as you mentioned, people building ways to at the end of the day, it's just kind of arbitraging information, right? We understand that there's a problem here and we think the solution is in our hands with the Bitcoin. And there's a lot of people who don't understand that yet. And you're taking advantage of some of the holes in the system. Tell me a bit about what you guys are building. I'm curious to hear about it. I know there's a lot going on, but if you can give me like some of the highlights, let's do it.
Absolutely. Because I think this last cycle actually showed us perfectly what happens when you embrace the fiat mindset, right? You had all these fiat bros come over from Goldman Sachs and all the big guys, right? They got the biggest resumes. They're the coolest kids on the block, but they came with a fiat mindset. And what did we get? We got BlockFi, we got Celsius, we got a whole bunch of hypothecation and rehypothecation, which led to destruction. And that's what fiat does. So we don't need more companies that are designed to extract value from their customers. If you look at some of the existing products on the market today, like I'm not going to name names, but there's a mortgage, a Bitcoin mortgage company where you come to them, you need to have a 680 credit score or better just to qualify, right? Imagine if you had like $20 million of Bitcoin and you can't get a loan because your credit score is 679, right? So you come to them, you need a 680, and then they give you the same terms, contractual terms as you would get in the traditional world. And then you have to post Bitcoin collateral, and then you get to pay a higher APY, or I should say APR. So this company will lend you money. Who in their right mind would go to this company? I would just rather go to like Quicken Loans or any traditional mortgage broker, because I don't have to post any collateral. I'm paying you to reduce your risk and you're charging me more. That's called value extraction. So real Bitcoiners understand that in a Bitcoin economy, a company has to deliver value. You're not going to earn Bitcoin in the future if you're extracting value from people. You're going to disappear real quick. Bitcoiners are smart. They can run the numbers. So this value extraction fiat Ponzi model completely breaks down. And Celsius, BlockFi, all these guys are a perfect example of that kind of BS. So what we do is we say, you come to us, we'll give you the same terms, but when you post Bitcoin collateral, do you know what happens? It reduces the risk for the lender, because now we have all the same terms of a traditional mortgage, right? You have a lien on the property, but you also have Bitcoin collateral. So yeah, the person makes a down payment. Yeah, the person has to qualify for credit, but they're posting Bitcoin collateral. And in a world where interest rates can go higher, even if the Fed doesn't want them to, or even if they go lower, it doesn't really matter. Bitcoiners, because they own the most pristine form of collateral in the world, are going to have access to the best interest rates. And by the way, not just regular plebs like you and me. You think Michael Saylor is holding Bitcoin on his balance sheet as just a speculative attack against the dollar?
No.
Businesses need access to these tools. Businesses right now go to the big bankers and they post treasury collateral and get special deals. Well, in the future, lenders are not going to be interested in your not pristine collateral. Bitcoin is pristine collateral. That's what you need to hold on your balance sheet if you want access to our money, if you want access to be able to borrow and at a lower rate. So people's reserve is about delivering value, because ultimately that's what Bitcoin does. It forces a company or a producer to deliver value, not extract value. And the self-repaying mortgage for me is really exciting, especially with where rates are right now, because imagine you're a Bitcoiner and you want to buy a $500,000, $600,000 home, and you're going to put down the $120,000 and you're going to get an 8% rate. And then this company's expecting you to post Bitcoin collateral too? F you, man. That's not. How about this? I'm going to post Bitcoin collateral, reduce your risk even more as the lender, but you're going to give me a 4% rate. And now we call it self-repaying because the Bitcoin is held at an escrow address. It's contractually protected. The borrower does not have access to it. But most importantly, the lender does not have access to it. There is no such thing as hypothecation or rehypothecation in this product, because that's a scam. And you will be able to monitor your collateral on chain at all times to ensure that it is where it's supposed to be, or else the lender is in breach of contract, which contractually brings harsh punishment. So the products are, and the ability to offer these products are there. It's just that look what Jamie Dimon said today. If he was the government, he would shut Bitcoin down. That is the resolve of your banker. You think your banks are going to accept your Bitcoin as collateral to empower you? No, we need people who truly understand Bitcoin and truly understand that you can't extract value from your fellow men. You need to deliver value to them. And then both of you will benefit. You'll make more money delivering value to people than you will extracting it from them. And with that self-repaying mortgage, imagine you put like $200,000 of, so you paid your $120,000 down payment. We put another $200,000 of Bitcoin collateral down, and it lowers your interest rates, which is awesome. But let's say 4 years later, the price of Bitcoin goes from 40,000 to 400,000. So somewhere in that process, you will be contractually allowed to either take back a portion of your collateral to maintain your loan to value ratio, or you can just liquidate a portion of your Bitcoin and close the debt altogether, save a bunch of money on interest over the years. And by the way, we're happy about that because we get our principal back and we get to write another loan. So it's a win-win scenario where when you own Bitcoin, you are going to have access to the best interest rates and pretty much the only products and services in the world that are designed to deliver value to you rather than extract it from you.
I think that's so great, man. I love that idea. I have long been a fan of using Bitcoin as collateral. There's a lot of companies, there's a lot of bad ones. Like you mentioned there, a few of them, noteworthy, of course, BlockFi, FTX, Celsius, who did the wrong things with the pristine collateral. There's one here in Canada. There was one here in Canada. I used to sponsor the show, actually, Ledin, who did a great job in risk management and didn't tank when all that other nonsense happened. And I just feel, I feel terrible for them because the government regulations here really push them out. I'm curious, in terms of government regulations, what sort of risks are you guys dealing with? What sort of hurdles have you had?
Yeah. Well, thankfully here in Florida, we have a lot of people working hard it's called actually the Florida Blockchain and Bitcoin Association. Some FBBA is the abbreviation. I forget exactly what it stands for, but they're to the point where they're working with DeSantis to possibly even get him to name gold and silver legal tender.
Love it.
Here in Florida. So in Florida, we're very progressive. What you said before the show about getting down here because people are like-minded, so I don't think we're going to be at the point where we're going to be able to launch our product nationwide at first. You have to crawl before you can walk, and you have to walk before you can jog, and you have to jog before you can sprint. I'm in a Bitcoin mindset. I'm not here to come take the world by storm. I'm going to take the world while you don't even notice it. And then one day you're just going to be, what? Where'd this come from? Because you have to start slow and prove that you can be successful. And then that's when you can start to scale. So we've been building this company with a Bitcoin mindset, with the right time frame in our mind to help Bitcoiners kind of unlock some of that trapped. Imagine Bitcoin goes to 250,000, even $500,000. You have all this wealth and it's just trapped in the internet economy. Yeah. You have all this equity, and there's no way for that equity to empower you in the real world. Sure, you could sell it, but like we talked about, tax obligations and all those other risks. There's got to be look, if Elon Musk can borrow against his stock, right? If Jamie Dimon can borrow against his stocks, if all of the richest people in the world can borrow against their assets and unlock that trapped equity, and those assets are not anywhere near as pristine of a collateral as Bitcoin, then why the hell is Bitcoin trapped over here? Well, for the same reason that Jamie Dimon just, look, this model destroys the fractional reserve business banking model. It really does. So keep me in your prayers out there, because once this starts going, we're going to be in the crosshairs, but that's okay, because we're about making life better. And that's what Bitcoin is about too. So we're a derivative of Bitcoin. We derive our truth from Bitcoin. We derive our drive and our motivation for what Bitcoin stands for. And that's what's going to make us stand apart from anybody else. And ultimately, I believe when you deliver value to people, you make much more money than if you try to extract value, especially Bitcoiners, because they will point at you and laugh at you and call you a scammer, as they rightfully should. And that helps the entire community. But when you get a good Bitcoin company like Bull Bitcoin, when you get somebody like Francis who knows what he's talking about and lives and breathes Bitcoin. He'd rather die than capitulate on any of that. I'm right in that boat there with him. I'd rather die than capitulate on any of this stuff. And we're going to build the products and services that we need. If the institutions want them, sure, come and participate. If you want to keep trusting them, fine. But we're going to do our own thing over here. And that's the ethos of us.
I love it, man. That's a great place to wrap. That's an hour of fire from you, man. I gotta say, I was gonna tweet out before the show that I like having CJ as a guest because I don't really have to do anything. I make all these notes. I'm pulling them up before the show. I'm going, I'm not even gonna need these. Honestly, we're gonna start talking and we're gonna go and go and go. CJ, thank you for your time tonight. Tell people where they can find out more about you, People's Reserve. The floor's all yours, brother.
Thank you. Yeah. And thanks again for having me. Love being back here. I love talking with you. You're great. And man, I wish I didn't babble on though, because I would have loved to talk about Bitcoin fair value, like you put in the,
it's in my notes. I mean, look, if you want to do, let's do 5 more minutes here because you got to tell me about it.
Okay.
This is your model. It's your data. Tell me a bit about Bitcoin fair value. I know you didn't want to share the sort of the proprietary stuff. Fine, of course. Tell me where it is. Maybe give me some comparisons. Why should we be looking at this now? Why is it important?
Yeah, absolutely. So Bitcoin fair value, it is proprietary, but I did open source the equation. So it's an unweighted version of the equation that people can see. Actually, if you go to the Bitcoin fair value Twitter and you just click the hyperlink in there, which is the ciadc.co/BFV, people can go read the report there. People can go read the report and see it with their own eyes, because I published that before the last halving, because everybody was asking me, what happens during the halving? How does it affect prices? How does it affect miners? What's going to happen to hash rate? What's going to happen to difficulty? A plethora of questions. And that algorithm is designed as my management system. And it's very simple. You'll see one of my most recent tweets. I said, Bitcoin fair value price just broke out to Bitcoin fair value, just with this recent move up to 44. It's only the 4th time in 7 years that signal's been sent. So, talk about having the right time frame and the right mindset. A lot of that stuff out there is like buy, sell, buy, sell, buy. It's like that is like the worst strategy. Like if you trade, you're going to lose. But if you have a long-term cyclical strategy based, so a long-term cyclical strategy, actually just go to my page real quick, because this will really help people visualize what I'm talking about. You just go down, you'll see the chart. It's got a big red cloud on it. Keep going. Right there.
There we go. Yeah.
That's the one. Yeah. Blow that chart up, because this was visualizing. This is
CJ's Twitter. This tweet's from I think like earlier this week, right? 2 days ago, something like that.
Yeah, not long ago.
Yeah,
at all.
the 5th, yesterday. Yeah.
So what you see here is the red cloud is the cost of production cloud. The bottom of the cloud is the electrical cost, an electric cost only. The top of the cloud is the all-in cost. So the bottom of the cloud is basically OPEX. The top of the cloud is basically OPEX plus CAPEX. So what happens is you have to have, as an investor, you have to be able to answer the question, is what I'm buying cheap or expensive? And when it comes to Bitcoin, the best way to answer that question is taking the market price and relating it to the cost of production price, right? So Bitcoin fair value is not attempting to say this is what the price of Bitcoin should be. That would actually be a pretty stupid algorithm. Like no algorithm could do that. And if it could, you'd be quiet about it because you could make billions. So that's not what this is about. This is about creating a baseline. And the baseline is based on the cost of production. And a lot of people say, well, that's the labor theory of value. No, it's not. It's business 101. Because if you believe in the value proposition of a product or a service, you must pay above the cost in order for that business to continue to offer that product or service. And if you don't want to pay above the cost, then that means that the product or service is not delivering value. Therefore, that's the free market price signal signaling to the producer, stop wasting your resources. Produce something of more value, of greater value that can bring in a profit, because people are willing to pay above the cost. If people aren't willing to pay above the cost, that's the market signaling to you that what you're doing doesn't deliver enough value. Redirect resources. So with Bitcoin, you'll see this is 7 years going back to the 2016 halving there on the 9th of July. this typically only happens 2 times. So a lot of people ask me, they're like, CJ, how do you, what's your strategy? How do you do this? My strategy is let Bitcoin do the hard work and just answer the question. Is it cheap or is it expensive? And when you'll see when price breaks out from the red cloud, which typically happens only 2 times per cycle. And fancy enough, we just got our second time from this most recent cycle. Now, the reason it happens close after the halving is because what the halving does is it doubles the cost of production for the miners. Overnight, without mercy, the cost of production doubles. So it's kind of hard to see in 2016, but in 2020, you can see that cloud double overnight. And it puts the price right back in the cost of production cloud. And within 3 to 6 months, price will break out of the cost of production cloud. And that's when you go to new all-time highs. But when you look back to after the 2018 bear market, where we went back into the price cloud, by the way, when the price goes back into the price cloud, that is when you buy, right? So this cycle is probably going to be my last cycle as a miner. So if anybody is out there and they need somebody for treasury management, you can feel free to hit me up. I'll come and consult with you because I'm out of the game. I think hash rate is going parabolic, and I don't think it's going to be. I think you're going to need institutional resources to continue to compete. So this is my last cycle, but I'd be happy to come help you refine your treasury management system, because instead of issuing debt, instead of raising, becoming a public company, this is what miners need to do. When price is at a premium, you sell what you're producing and you build a cash position. So you saw that after the 2016 halving, price went to a premium. Well, every single day that miner should be selling and building a huge pile of cash in anticipation of deploying that cash once price goes back into the red price cloud. And that is how a miner can actually, without losing cash flow, build a Bitcoin equity position on their balance sheet, right? Because it's a confusing question. Does a miner mine the Bitcoin and then just hold the Bitcoin? But if you hold the Bitcoin, you can't get the cash flow. You can't settle your debts. So the best way to do this is to collect the cash, build up a big cash position during the premium phase when price is above the cloud. And then when price goes back into the cloud, you don't just mine with your hash rate, you mine with that cash position. And the difference, the profit, the difference made in that, once price comes back up, turns into how you build your real Bitcoin position. So not only can you earn Bitcoin and mine Bitcoin, but you can also build a Bitcoin position on your balance sheet. Well, what's good for miners is actually good for people like you and me too. Because if you use this same strategy and you say, okay, when price is in the red cloud, I'm going to buy, and I'm going to buy like there's no tomorrow. And when price goes above the red cloud, you don't necessarily have to sell, but you definitely stop buying, right? You let your cash flows build up during that time. You don't have the dollar cost average in during that time. You see a lot of people, I love Wicked S Bitcoin has a sick chart about if you dollar cost average in from 70,000, even until today, you're up 50%. But if you dollar cost average in when you were in the red price crowd, you're up like 150%.
You guys are saying the same things. It's just that you've narrowed it down and really quantified, CJ, where the sweet spots are, right? This is a great strategy. And actually, to your point about treasury management for miners, my co-host Len and I have disagreed over the years about whether miners should hold or sell Bitcoin. I have always been in the case that they should be selling, because if you don't sell when times are good, you will be a forced seller 100% of the time. Period. End of story. This is so much tighter an explanation as to why. And I'm surprised that more people don't understand this. Surely people have asked you, like, where, if you back tested this with like some of the miners specific, like the way they've handled balance sheets, the way they've brought in Bitcoin through their mining revenues, or is this just a steady, this is going to work no matter what because of the way you build up your cash during the good times and use it during the bad times?
Yeah. So really the only reason I've went this much in depth is because this is my last cycle using it, and miners are very competitive. So I doubt anybody is going to, care about this. They have their own strategy and they're right and you're wrong. And that's kind of the mindset you need to actually be successful. But for people who really want to optimize their treasury management, there shouldn't be humans making a decision. It should be algorithmic. And that's what Bitcoin Fair Value does. It makes treasury management algorithmic. It removes the human element, right? Bitcoin removes the human element from policy. Well, Bitcoin Fair Value is an algorithm that removes the human element from treasury management. And it boils it down to the most important question, which is it cheap or is it expensive? And this is a basic commodity cycle, by the way. This is true to every single commodity in the world. There's no difference for Bitcoin. The only difference for Bitcoin is look at the bottom red line. Notice that that bottom red line is going up. There is no other commodity in the world where its cost can be increased by the commodity itself. The difficulty adjustment as hash rate grows and the difficulty increases, right? Price drives hash rate drives difficulty drives costs. So yes, it's very fun to talk about the 20,000 peak and then the 14,000 through the expansion phase going into the halving, and then the 70,000 peak and the expansion phase we're going into now before the halving in anticipation of that doubling of cost to get the price to where it needs to be to maintain profitability. It's very fun to talk about the tops, but what's more important are the bottoms. And Bitcoin is the only commodity in the world that can raise its price floor, because as in any other commodity, as the premiums grow, the supply expands. Bitcoin's supply can't expand. And then a lot of other commodities, you know, Jeff Booth is really good at pointing this out. There's technological deflation. So the technologies make you more efficient and the cost of production actually goes down. But for Bitcoin, the cost of production goes up. It was engineered. It was strategically designed to leverage the natural laws of economics, commodity cycles, and price discovery to empower we the people. And this algorithm is based on that understanding of Bitcoin's engineering. And you can't beat it. I mean, it's a very simple process. Like right now, it's a lot of fun. But if you're a miner, you know, it's time to start locking in profits. And it makes sense because guess what? You need to raise funds for your OPEX after the halving. Your margins are going to get slashed 50%. You're going to get crushed in just a couple of months. So you better be raising cash right now to carry you through that 3 to 6 month period after the halving before we get a new all-time high price discovery. And one last thing I'll say is if people go on and they read that BFV report, I give you an example. I give you an exact mathematical example. I fill out the equation with the real world numbers back on May 5th, 2020, when I published that report. And I show you what happens after the halving. So you can see how each variable changes after the halving and why the halving is actually the catalyst to a new price discovery cycle, because it's based on the new cost structure economics of Bitcoin, the only asset in the world that can raise its own floor price.
I don't even know where to start. I mean, this is the kind of thing that, I mean, I don't know how you feel about stock to flow. I look at stock to flow and I think it's like, or almost too rudimentary. And I think like something like this deserves so many more eyes and so much more traction, because really this is taking into account all the things that stock to flow is implying, but not really accounting for. And you've done a great, this is incredible stuff. I'm going to dig more into this.
There's 5 variables in the BFV equation. Stock to flow is one of those 5 variables because it does properly account for a perceived value based on a limited supply against a rising demand. So it's not just like BFV itself. It's a true stock to flow. I know stock to flow got popular, like this is my price target, but just like BFV output, it's really a benchmark that you compare the price to. And stock to flow is not as effective by itself because it's not taking into account other important variables. But if you go look at what those 5 variables are, I'm sure you're going to have an orange pill moment that is going to make the way you manage your Bitcoin in the future a lot more easy to understand, and more importantly, a lot less emotional.
That's the most important thing. Emotion kills people. Markets are an expensive place to find out what you're made of, as the saying goes. And you want to know what you're going to do at certain price points, what you're not going to do at certain price points. And as you said, to take out your heart from making those decisions is maybe the most important thing anybody can do, regardless of position sizing and risk appetite. So CJ, thank you for, we went a little over time here. So thank you for that. Now tell people where they can find you.
Yeah, I'm sorry, guys.
Bitcoin
I got
fair
going
value.
I appreciate you letting me touching on this though, because I love that you put it in the description. And for the people who come across this, this is really going to increase the quality of your Bitcoin experience. So don't hesitate to reach out to me if you have any questions or concerns, but please read the report first before you reach out to me. But you can reach me on Twitter at CJ Constantinos, on YouTube, same handle at CJ Constantinos. Probably about 8 months from now, we're going to be moving into beta for People's Reserve. Man, I couldn't be more excited about what we're building, not only for plebs like us, but for people like Michael Saylor who are smart enough to keep Bitcoin on their balance sheet. Bitcoin businesses and Bitcoin plebs are going to be empowered like they've never been before with the introduction of these never before seen products and services because of our understanding of Bitcoin as the most pristine collateral in the world.
You love to see it. CJ Constantinos, follow him, watch him, listen to him. Until next time, everyone, take care. Be good out there.